Tyler, despite all appearances, every stock is not actually up from its highs over the past year or two.
Yeah, that's the point of there being thousands upon thousands of stocks actually listed. Not everyone's doing great, Bob.
That's true. Thanks for getting the Office Space reference in there. I really appreciate that. I'm Jason Hall. This is Investing Unscripted. And Tyler and I, here's the thing. A lot of the stocks that are off their highs don't recover. They never do. So the challenge is finding the ones that are off their highs that actually have the businesses and the right valuations to generate alpha, to generate great returns from that price going forward. Tyler and I have two that we have a lot of conviction can generate great returns for investors who buy at these prices. Before we talk about it, though, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Go to that link anytime you want to. You see it right there on the screen. If you get bored with this video, take a break. Go check out what the Motley Fool is offering. Come back. We'll be here waiting. Tyler, let's get into it. And you and I are going to talk about two very different stocks. I'm going to lean out more on the risk curve, talk about a business that maybe now's a good time to be accumulating shares to start that process. You've got one to talk about that I think at these prices, a lot of investors might just want to go ahead and go whole hog, get your full position now. Think about owning something that's going to pay you to own it and is really part of the tailwinds of housing. Might be a good company to look at.
Yeah, Jason and I are going to debate because that's what we do, but I'm going to call it Mid-America Apartment Communities. He calls it M because he says they officially changed their name, but I say that it's still on the filing.
So the corporate name is still Mid-American Apartment Communities, Inc., but the business refers to itself by the shorthand MAA, the same way Dairy Queen is now DQ, Tyler.
Yeah.
I think part of the reason they did it is because MAA, and you're going to talk about this is the biggest apartment REIT in the U.S. Most of their stuff's not in the middle of America. They're mostly Sunbelt and Mid-Atlantic.
Yeah, so as Jason hinted to, it's a residential real estate company, mostly multifamily units across much of what is now considered the Sun Belt. So basically Southeast, all the way stretching across to pretty much Arizona and dabbling in California as well, but a little bit less so because typically the California market looks a little different than much of the rest of the southern part of the United States. The reason it's over the past year, it's down about 25%, and it's down even further off of its highs back in 2022. A large part of the reason for that can be distilled down to a couple things. Number one, rising interest rates. Obviously, most real estate companies, to a certain degree, are held by people who are looking for yield, and when treasuries are 5%, you can basically have your cash sit in a money market and get 5%. Your 2% dividend yield from your real estate investment trust all of a sudden doesn't look great. And so
there's how it plays out in real time, Tyler. You see here, beginning of 2022, when that federal funds rate really started to go up. And that's exactly the same time that we saw Mid-American stock price start to fall. And it wasn't just that interest rates were moving up. It was also Mid-American stock was trading at an incredibly high premium multiple back then. It was priced for interest rates to stay low, to, again, for REITs and other those sorts of assets to be the only game in town for yield. And also with these expectations that it was going to grow 10, 15% per year that were probably unreasonable expectations.
Yep. And just to add a little extra wrinkle to recently as to why, even though rates have flatlined, but Mid-American still seems to be going down a little bit, is there has been a lot of multifamily construction going on in the United States. In 2023, active under construction multifamily unit housing was the highest it's been in over 30 years. I think it was even approaching 40 years since we've seen apartment building construction this high. So there is this backlog of a lot of apartment units just sitting and being built, ready to go to market, which for a lot of these apartment owners, landlords, they've been able to jack up rents incredibly high. We're talking 12, 13, 14% annually, which for apartments is, let's not try to dance around it anyway. It's absurd and I would argue unsustainable. So with that backdrop, you have a lot of new supply coming online, higher interest rates. All these things just was a correlation of things for this particular company. And as a result, it's way down. However, as we mentioned, they are the largest, one of the largest, I think, if not the largest right now in terms of total units. Extremely well placed because, as we said, Sunbelt, it is a slightly more volatile market. So like it's, the ebbs and flows of the economy are going to affect the Sun Belt a little bit more in terms of economic activity. When things go down, they're probably going to get hit a little bit harder because there's more supply and things like that. But in good times, it's going to grow at a higher rate. And Mid-American has also done a very good job of keeping its properties furnished, lots of amenities, and so therefore been able to get premium rent rates as well as keeping high occupancy levels. So good operator in a relatively good business and isn't like in a distressed situation. As of right now, it has a total debt to EBITDA ratio of 3.5 times. So it doesn't look like in any particular way they look like a stressed or have distressed assets on their books. And that could be an advantage in the future in the event that other apartment companies start to get distressed. Just as an anecdotal example, I'm invested in a private real estate syndicated deal, and they're going through a refinancing issue right now where I actually got capital called because there's a lot of people that penciled really bad deals. And that was probably one of them. And at the time, it looked conservative. So if that deal is going sideways, there's a lot of deals going sideways right now. And a company like Mid-America could take advantage of that.
Yeah, exactly. So again, the 3.4x net debt to adjusted EBITDA tied to its real estate, its rents. You see right next to it, the credit markets recognize that strength too with investment grade, which means that they're going to continue to have both access to liquidity and also access to relatively affordable liquidity, even in this rate environment. So I think that's really important. I love it when the market gives us, stinks if you bought near those highs, but for anybody with money to deploy right now that's looking for strength, it's a great opportunity to buy. Like I said, I think this is the time that you can start creating a full position. Tyler, let's go in a completely different direction. Lean out on the risk curve a little bit. Let's talk about a business you and I both followed for a very long time that I own shares of, and you own shares of its frenemy in the space. Let's talk about Enphase Energy. Competitor. Yeah, they're absolutely direct competitors. There's no doubt about it. They basically share the lion's share of the U.S. residential market for the panel level electronics on solar panels, the things that turn the DC that panels make into the AC that the U.S. grid operates on. Massive market share in the U.S. and looking to build share across the pond. They just reported fourth quarter results. I'm going to pull up the earnings release because I want to just show what's happening with the company's revenue right now and how it's not pretty. Not great, Bob? I think, Tyler, not great, Bob?
Not great, Bob.
Here you go. So it is certainly not great. So again, this is looking at the quarterly revenues going back to 2022, third quarter revenue compared to fourth quarter revenue. So fourth quarter 2022, $724 million. Third quarter or fourth quarter 2023, down more than half, $302 million. By the way, Tyler, that was the bottom end of their guidance. Their guidance range was 300 to 350. They eked out within management's guidance. Operating loss of $10 million. Now look at these substantial low six-figure operating margins that the company has generally generated in prior quarters. So what's going on? What's the background of this? And why is the stock down? I don't know, was it down still 60% or so from the high? The short version is that the residential solar market is going through a massive downturn. It's a very cyclical industry. Remember that interest rate thing that we showed with MAA, with rising interest rates? What else takes a lot of debt? Putting a solar system on your roof of your house, right? So rising interest rates have substantially slowed consumer interest in that. And then there's also some other regulatory things like in California and other markets that have affected it. Europe has slowed down substantially. It's a normal part of the cycle, and it takes these pauses before the market readjusts. And it is absolutely hammering Enphase's stock price right now. Here's the good news. Enphase is still making money. The operating loss was not good to look at, but still generating GAAP positive cash flows and GAAP positive net incomes, partially thanks to the IRA, the Inflation Reduction Act, which created substantial incentives for the manufacture of renewable energy related things in the U.S. They have a large manufacturing capacity footprint in the U.S. through third parties, and they're looking to actually start ramping up that capacity. One of the things that they're doing because of this slowdown in solar, they're shuttering some facilities. One of them is in Wisconsin. The other one's in Romania. They're shutting down those third-party manufacturing facilities, and they're transferring the equipment to a facility in South Carolina and a facility in Texas. What they're doing is they're reducing their footprint for now, while also positioning the business for when the solar market does turn. It is going to turn back to growth. There's no doubt about that. They're going to make sure they have the capacity going forward. And it is absolutely beneficial right now from an economic standpoint to work with US-based third-party manufacturers to do that because of the tax incentives. It was like $23 million in benefit that they got in the fourth quarter. They're anticipating, even with the slowdown continuing in 2024, another $10 to $15 million in benefits in the first quarter. Here's, Tyler, how I view this. We know we haven't hit the bottom. Company's guidance was 300 to 350 million in revenue in the fourth quarter, came in at 302. Their guidance for the first quarter is 260 to 300 million. We are still approaching the trough, Tyler. This is not a time, I think, to go whole hog, buy a ton of shares of Enphase. I expect the stock is going to stay incredibly volatile while this plays out to the downside and then back to the upside when the market does finally bottom and we return to growth. I think now's a good time to start accumulating shares of a business like this. Maybe take a starter position, follow them each month and each quarter as they report sales data and as they report their financial results. They have tons of cash. They have $1.7 billion in cash. They have a very strong net cash position. So they can get through this environment. They can downsize, be ready to scale up, throw money at scaling up when the market does recover. Chances are when that happens, the stock is going to go gangbusters because this is a great business that generates tons of margin and really good cash flows. But now I think is a good time. If you're on the more risk tolerant side as an investor, now I think it's a good time to be looking at buying Enphase shares.